Welcome, Portfolio Builder members, to our Thursday Trade Alert where we play the bond market. Got to start off with a quick disclaimer. Trading is risky and you can lose your entire investment. These results are based on hypothetical model portfolio and not real money trades. This is not financial advice. Some of our staff does follow the trade alerts and they receive the content at the same time as everyone else to avoid any signs of front running or anything like that. And for those of you who want to automatically get our live stream each day, please make sure you subscribe to the channel. And more importantly, click that little bell in the bottom right hand corner. That will automatically notify you of our daily live stream. Now, a quick review of our program. Our goal is to generate consistent retirement income with low risk. To do so, we've designed a trading strategy that takes just 2 to 5 minutes of your time, and it only takes, at most, a daily trade alert right at noon Eastern. But we do have options to reduce the frequency of trading if that's in your interest. Now, our most avid followers like to do the trade alert daily, and this is how we currently recommend breaking down $100,000. You would have 100 shares following the SPY, Monday, Wednesday, Friday, noon Eastern, quick 2 to 5 minute trade alert. This is also using the options market to protect the downside on these assets and still make consistent income by selling covered calls. Tuesday is currently playing Facebook, and you can get into 100 shares of that for just under $20K. And again, you do need multiples of 100 shares because our primary strategy is to buy put options below to protect the asset and then to sell call options above to normalize our return, finance the put options, and generate consistent income. And then meanwhile, we recommend having 300 shares in the TLT, that's the long duration Treasury ETF, and that's the trade alert we're covering today. On top of that, we're recommending that you have 10% of your assets buying and holding gold. Currently, we like the ETF GDX. We were in GLD, but now that the trade war is getting to a critical juncture in the next 3 to 6 months, we're looking at GDX, the mining ETF, which will generate a much larger return than GLD if this trade war does go on for a long time. Now, for some people, this setup makes a little more sense, where you would trade the SPY Monday, Wednesday, Friday, and then the TLT on Thursday. This portfolio costs approximately $66,000 to build out. And of course, if you want to multiply it, just double, triple, quadruple the asset allocation. This would get rid of the Facebook trade on Tuesday and make it so you're only trading Monday, Wednesday, Friday on the SPY, and then Thursday on the TLT. Now again, all trades are at exactly noon Eastern. They take 2 to 5 minutes max to execute, and then they're atomic bomb proof. There's no way to lose much on any given trading period, so we don't ever alter the trades outside of these trading periods. Now again, we still want you to have 10% position into GDX, and we'll also look at how you could better diversify that inflationary hedge in the gold market with some cryptos, which are at a discount today. We'll take a look at that in a little bit. But if you just want to stick to someone like Interactive Brokers or TD Ameritrade, they don't sell the crypto products. So for this summary, I'm only assuming you get that part of your portfolio filled with GDX. Now, this is the really lazy man's strategy. And it actually would have had the best return by far if you had followed this strategy, where you take the Tuesday trade, which rotates. It's not always Facebook. Right now, I like Facebook the best, but in the past, we've done Apple. And what I've been telling subscribers is expect me to hold Facebook till the SPY gets back towards 300. At that point, we'll rotate into Microsoft because at some point, I think once we do break into new highs, at some point, I do see the trade war escalating to a critical juncture in the next several months. So when that happens, we don't want to be hanging on to a growth stock like Facebook. We'll be tying ourselves down to a little bit safer income once equities get super expensive. And once I think the rope is at the end for the equity run that we're coming into, we may rotate into a silver ETF for the Tuesday play. So expect on big drops in equity valuations, I'll probably buy either Facebook or Apple in the midst of a big drawdown in equities. Then as we get towards all-time highs, we'll probably rotate into Microsoft. And then once we get to nose-bleeding prices, once again, we'll expect that Trump gets brave, escalates the trade war, gets frustrated, whatever you want to have it. And that's when we'll hopefully be positioned in silver. So that's kind of the plan in terms of the rotation on that Tuesday trade. This allows you to get following the program with a lot less capital, multiples of about 37K. So if you had 100 grand and you wanted to follow this program, you could multiply all these by 3 and have quite a portfolio. Now we'll look at the returns in a little bit. For those of you getting this trade alert today, but you didn't have the trade content for today's new alert, that's because your free trial has expired. So if you want to make sure you get the trade alert, call Dean at 505-322-7515 for special pricing. Do want to remind folks that we have a paid webinar every Wednesday at 1 Eastern, which was yesterday. And then today we have our free group. So unlike this live stream chat where you can chat with me with text, in the webinar, we actually turn on your microphone so you can talk to one another. Okay, so let's take a look at the most recent trade, which came off very profitably. And I'll start off by looking at the summary of our returns. Let's just see if we have any questions in there. Anybody got questions, please feel free to post it in the chat box. But let me zoom in here. Okay, so here's been our returns to date, and you can see our Monday, Wednesday, Friday SPY trade generated a huge return in the most recent trade. We were betting that trade war would de-escalate during this period. We'll look at the news as to why, and that we'd have a strong rally in equities. That's just what's happening. So our Monday, Wednesday, Friday trade jumped quite considerably in terms of return, and on the same note, we were also long the bond portfolio going into this period. Today's trade is not going to bet up on the bonds. I think we're going to have a period where bonds sell off. Unfortunately, our metals and crypto are most likely going to have a little bit of weakness during this period, but we want to have that insurance in our portfolio. We'll talk about why. And for the foreseeable future, I think equities will rise far higher than they are currently. So we're looking at a bullish move in equities and a bearish move in the bond market as the current period unfolds. So we'll talk about some potential risks to that outlook, but that's how we're currently playing the market. And do realize that Tuesday trade, if you do want to follow our program with a limited budget, has a insane 18% return this year. And that's not just by buying and holding various equities. That's with selling selling call options, which limits the upside profit, and buying put options, which helps prevent drawdown, but also takes away some of the profit. So that's a huge return considering how safe those weekly trades are. So, okay, let's look at the current trade alert results for the Thursday play. The Thursday play has been extremely profitable. This is the first time I'm putting a bearish bet on the TLT this year. We've been just betting up, 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 and the TLT has climbed all year with very little drawdown. You can see our only losing period on this was on February, where we had a negative 0.8% return. Other than that, the TLT has been a very strong winner for us, returning 2% in December, almost 1% in January, 3% in March, 0.5% in April, 1.7% in May, 1% in June, 1.3% in July. August, a blowout return of 3.2%, and today was another huge winner. We were long the TLT. We missed out on a lot of the profit. This return would be even more insane if we hadn't sold the call option at 145.50. We did. Most likely you were assigned. If so, you're going to have to buy back your shares today. If not, sell to close that 145.50 call, and your profit's going to be $1.22 plus 35-cent profit on the option caller. So we get to make a profit on the TLT portion of the trade of about 157 per share, just a little bit over 1%. Now that's not all. We did take part of the credit and put 31 cents down on a call option on gold, Barrick Gold. That puppy was up over 250% yesterday. Today it's only up just over 100%. We sold that for 68 cents, and that adds another 35 cents per share of the TLT, because this is all based on multiples of 100 shares of the TLT. So the net result is we come in at a profit of $1.94 per share. If you annualize that, that's a huge income per lot of 100 shares of TLT. This is an abnormal return. I don't expect to deliver that frequently. Now we got around $1.80 2 weeks ago. We lost 80 cents the week prior. Overall, this has had a very healthy, easy profit. Now today's trade alert, I'm not going to cover in the live stream. If you do have questions about it, please feel free to chat. This is how we protect the paid content from making its way into free followers on the live stream. But today's trade is a bearish bet on the TLT that I expect it will just trade flat or slightly down, and if so, we'll earn around $100 per contract. So not quite the potential we had on this trade, but I do think we'll see the bond yield slowly creep up a little bit as the equity market travels higher, and the fears of the China-U.S. trade war escalating, I think, are going to have a period of calm right now. Now, that's not to say I believe we're out of the water completely, but I think we do have a period of calm. So I'll go to the most recent trade just so you can see how this all worked out. Okay, so this is the trade we put out on August 22nd, just so you can see how the math worked out. So you can see we had sold the 145.50 call, and this shot up to as high as 148 yesterday, selling off today, which is fine. We don't mind missing out on the profits. What we don't want to do is get hammered with a big loss. So we had that put option below at 142. So we lost all the value of the put. We got to keep the 93-cent credit because we were assigned, and then we also get the spread. So you can see when we issued this trade, TLT was at 144.19, and we were agreeing to sell our shares at 145.50. So we got to keep that profit plus the premium of 93 cents. Now the guy who bought the call option made a huge profit, but that's okay. We've been missing out on profits all year on the TLT and have generated a very safe return with very little drawdown consistently. Now the other trade we gave out last week, which we're not doing this week, is a call option on gold. We're still exposed to gold with 10% of our portfolio in the GDX ETF, which is the mining ETF, and I'm still recommending tiny chunk of that going to cryptocurrencies, but I do think we're going to have a period of likely weakness in this part of our portfolio. So we didn't leverage the call option on the gold this week and are just doing a straight play on the TLT, expecting some drawdown. So again, that's how we got from last Thursday to this Thursday. And that call option on gold was sold for 68 cents. Yesterday it was over $1.10. So that's okay. And again, today's trade alert's a little different. And if you have questions about it, we have a webinar where I will cover it coming up in about 40 minutes. And if you're an active member and you see the trade alert below, then please, if you have any questions about it, post it below. It's one of those upside down callers where we generate a profit if we go flat or slightly down from here. Can't lose a lot no matter what happens, but this plays in well with our bullish play in the SPY. Okay, so that's the Thursday trade. I did want to show off how well we're doing in this trade. So this will actually, quite frankly, it might be the biggest profit, close to the biggest profit we've had in this portfolio. My big macro look was that yields are negative in the bond market around the world, except for in America. China is devaluing their currency, which is causing other currencies to have to devalue, which if you increase the monetary supply around the world, that's going to drive up the value in dollar terms of all the hard assets in America. So that's the dollar, the U.S. stock market, and the U.S. bond market. And so we've seen exactly that play out as the rest of the world really suffers from all the pressure the U.S. is putting on China. And again, China's been the growth engine for the rest of the world. Now, will this all catch up to America? Probably, but just I don't think that time is yet. So right now it's forcing capital to flood into the U.S. And so that's why, despite having the sell-off, the news yelling about recession, the yield curve inverting, on and on and on, we stuck to our macro view, which said that SPY has to go up because there's nowhere else in the world to invest your money. And in fact, if you're buying bonds around the world, you're doing it as an insurance play to protect, really to just protect your long equities positions, because you're not going to make any money with a negative yielding bond for 10, 20, 30 years. It makes no sense. So people are buying that because they think if stocks crash, the bonds will continue to rise and they can get out by selling it to who knows who they think they'll sell an even more negative yielding bond to, but perhaps to its own government. Anyway, SPY is trading way above our prediction of 191.50. So we're sitting on a $3 per share profit on this trade alert from yesterday, and that's after losing on the put. So we had the downside protection on this. So if trade war had escalated, atomic bombs are going off, doesn't matter, we would still have a very small maximum risk on this trade because of our put. And on the other hand, we didn't go too far above that 291.50 call, so we've enjoyed most of the profit of the jump today. Last I checked, let's see what the SPY is trading at. Okay, 292.68. So we're about $1 above where our profit tapped out at, which is okay. You know, we always feel like we're missing out in this program, but as you can see, that's the cost of making sure we have very extremely low risk, and that's how we can consistently finance our put options, primarily by selling the call. Now, again, when the equity prices get more expensive and we're at nose-bleeding prices, I think we're back now. Okay, good. All right, we're reconnected. So yeah, in our program, once again, we're generating very safe, consistent returns, but perhaps the biggest drawdown is sometimes we get the prediction correct and then we miss out on some of the profits. So TLT, we would have had an extra $3 of profit if we hadn't sold that call option. SPY, right now we'd have an extra $1. But again, we're trying to generate safe, consistent retirement income with extremely low risk. If things go haywire, we always have downside protection in terms of owning a put below the core asset. And by doing so, that makes it extremely hard to have a big loss. On top of that, in general, our bonds and our stocks can balance one another out. Now, in this case, I've designed the trades this week to profit from bond yields rising or bond prices going down, TLT going down, SPY going up. So if I'm wrong, and the trade war escalates, most likely we'll lose on both parts of our trade over this period. So that's just important for everybody to know. This trade, again, is in its max profit. Let's take a look at our other trade on Tuesday. And then we'll jump into the news. What I'm going to do now is pull up our latest Tuesday trade alert so you guys can see how that one's performing so far. And then we'll jump into the macro news and get ready for our live webinar in 30 minutes. Okay, so I know everybody hates Zuckerberg, thinks he's creepy, doesn't like Facebook stealing all your info. But what I want to point out is that these guys have a pretty clear monopoly in the phone app business. And the phone apps are actually slowly becoming more used than computers. And so if you think of it from that point of view, Facebook's a brand new spanking company in terms of being publicly traded. They're barely starting to figure out how to monetize their huge user base. Oh, we got a question from Martin. What's going on? World War III yet? No, not yet. I think, well, we'll look at the macro news, why I think we have a period of calm ahead. And so Tuesday trade, just why we like it. So Facebook, number one, has an absolute monopoly in the social media space outside of the rip-off of its product in China. And again, you can go look at China. They've ripped off every single thing that's popular around the world, and they're just using their closed-door system to maximize the profits in their big economy. So other than that, Facebook really has zero competition. It has most of the top used apps in the world, if actually almost all of them outside of WeChat and TikTok, two apps by Chinese firms. But other than that, Facebook has a monopoly in the app space. They have 2.6 billion users. Something like 1/3 out of everyone in the world uses their technology. And they're developing a new product called the Libra due next summer, which I think could be a game changer in terms of helping Facebook generate a higher profit per user and become a more dominant player than they already are in the world. And so I won't go into the details of that just yet. In this video on Tuesdays, I'll cover it in more detail. But when equities are heavily sold off, like they just were, I want to pick something like Facebook for our Tuesday play. And so this one makes its maximum profit if by next Tuesday we go above 190. And let's just see where Facebook's at right now. We're at 185.75, and I believe this will pop considerably higher by next week if the current trend stays intact. So as you can see, it's had this huge sell-off. As Facebook gets near all-time highs, again, my plan is to switch out that into Microsoft, which has less drawdown when sell-offs happen. And then once I think we may have a serious risk of trade war escalation, will rotate into SLV on the Tuesday trade. Okay, so that's a wrap of the trade alerts. One more time, I'll just look at our track record. Again, if you do combine all the trades into one portfolio, your year-to-date return is 17%, and you've only had one losing month, -1 return in July. If I go through each track record individually, the SPY program has had 2 losing months total, the biggest drawdown of -1. Now consider in May, the S&P 500 had drawdown of -5%. So we're dramatically reducing drawdown in our program. Now that may mean we make a little less than the underlying asset does on its own, but you're going to have way less stomach aches because of losses in your portfolio. We're very defensive. Tuesday trade has had kind of a nasty hit in December, but that was during the Christmas massacre. And again, it's only trading on a weekly basis, so it will get caught off guard when the trend changes. But when the trend does go on a path we predict, it can rack up huge returns. And so you can see in June we had a huge 6% return, January 7.7, and just a little bit bigger loss than in the SPY in May and July. So there is good argument that the Tuesday portfolio does deliver a better return, but again, it is with bigger drawdowns. Metals portfolio might stay flat if we're lucky this month, but I want to own it for the surprising escalation in the trade war. I don't know exactly when the trade war is going to escalate, but I'm quite certain it will. I just think we're going to have a period of time of peace. So we're not adjusting this buy and hold portfolio at all during this expected period of peace. Because that's the whole point. They're going to raise the escalation when no one's expecting it, quite potentially, and that's when we've seen some big boosts in this portfolio. The other thing is we have the Fed potentially lowering rates and even buying up Treasuries already, and that could be a very bullish sign for metals coming up around September 18th. So I don't want to miss out on that. This portfolio may just have a relatively flat period right now. We'll see. Bond portfolio, we did our first bearish trade on the TLT today. And again, it's a setup where we don't lose much if bonds go higher. If it goes flat or down, we make about $100 a contract, which is just above 0.5% return per week on this trade. Now this again will just be until the sell-off goes down a couple dollars on the TLT, and then we'll flip right back because I do think bond prices are going much higher as the trade war really has no end in sight. Okay, let's look at the macro information and we'll wrap this up and get ready for our live webinar that's starting up in 30 minutes. Okay, so markets are up big because China indicates it won't retaliate. They're having a big celebration. I can't remember if it's the 70th or 80th anniversary since Mao. And they're hyping up President Xi as not only their president, but almost as a spiritual leader, making it illegal to follow quite a few religions, putting people in different, they call them re-education camps. So it's quite a ruckus, but I think China wants to have a period of peace while they celebrate their, I believe it's the 80th anniversary. The same time, stocks have taken a big hit from the recent tariffs imposed by the U.S. So I think we're going to have a nice solid period of peace while both these economies try to recover. And so far that is playing out very nicely. We can see everything's up. Here's the core stocks I follow, SPY. Again, I'm expecting it to jump past 300 in the next several months as the general trend continues where the pressures we put on China is causing them to devalue their currency, which is causing other countries surrounding it to devalue, strengthening the dollar and all hard assets relative to the U.S. So I do expect all the prices in the U.S. to go up. Just due to the increase in monetary supply around the world happening right now. And the only catch is the SPY is very news sensitive to trade war escalations. So I think it was repriced and will, without any serious pressures applied, will just float back up into the 300 range and probably bounce around between 300 and depending on what the news flow is, maybe up to as high as 315. TLT, I do believe, will travel higher before this mess is over. But right now, we are betting on a flat or downward move for the week over week. And we did not buy a call option on gold like we did the last several weeks, which has been highly profitable. HYG is the high yield corporate debt bond, which I believe will probably be the first to crash, then the investment grade bonds, and then the US Treasury bonds, and in between all that, the equities. So I keep a good look on that for signs of weakness, looking strong today. Investment grade corporate bond, until this thing cracks, I don't see how you get a major sell-off in the leaders of the SPY. So we're talking about Microsoft, Apple, a lot of these companies. But buried into this bond fund are companies that are very weak, like General Electric, probably the biggest borrower in the investment grade box with a relatively bad credit rating, and could easily get re-rated into that high yield fund. So this is potentially where the credit market needs to crack before we would probably get super worried about stocks losing their number one buyer, which is just central banks and corporations, not real investors. FXI, the large cap Chinese ETF, showing some strength down at these suppressed prices. And we got to remember the banks are highly connected to China at this point. So if we do manage to break away from China, there's going to be a lot of resistance from all the banks who are partnered up with China as their number one client. Remember, they take 90% of the money and give it to 1% of the people. And with a $12 trillion a year economy in China, that makes that 1% of people extremely powerful. And they have their hands in everything. Okay, GDX is the mining ETF we like, and might have a little bit of a lull right now, maybe even a little bit of a sell-off, but I want to remain long. This represents 10% of our total portfolio right now. Now, if you want to take 2.5% of that 10% and split it half in Bitcoin and half in Ethereum, that is what we're recommending for people who want to bother with that. And right now, these are selling at a discount, and I believe it's again because of the expected ease in the trade war as we go into this anniversary for China. So I do think that this is a good buy the dip opportunity. But in total, you'd only have per $100,000, you'd have 1,250 holding Bitcoin and 1,250 holding Ethereum. I like Robinhood app for crypto, and I like Interactive Brokers for trading our equities products. Okay, Facebook's our Tuesday play. You can see this pattern setting up. Potentially we've jumped into it at a good support level and can ride it to new highs, at which point again we'll switch to Microsoft for a few more weeks, and then once we're at nose-bleeding prices, switch to silver, expecting trade war rhetoric to get brave once we're back to new highs. Here is the Russell 2000, still showing a lot of weakness, and indicates that perhaps the longevity of the U.S. equity bull market is running out of steam. And so again, I do expect money to flow into U.S. equities, but it's going straight to these top companies, and it's not showing that the whole U.S. business sector is really thriving yet. So for me to think we're going to really go above 300 on the SPY and stay there for a considerably long period of time, I'd want to see this showing a lot more strength. And this is, again, Stanley Druckenmiller's indicator for stocks. Deutsche Bank, we keep a close eye on. The German bank potentially has some major risks. They've been firing people, laying off people, trying to restructure the company. If this were to fail, it could be a big problem for... Oh, let's see, we got some chatting going on. Hey, Rich, thanks for your comment. He wrote, "It's good for me since I'm able to sit in every day. I'm just amazed where we're at with the volatility of the market. Yep, it's getting pretty wild, but I do think we have a period of ease ahead. Okay, next bank I'm carefully paying attention to is HSBC. Very odd. They had nice profits, but there's a scandal going on involving their bank financing the exchange rate of the Chinese currency. A bunch of people got fired. I don't have enough time to really dive into all the details of it, but this is a huge bank. Supposedly they've stopped supporting the Chinese currency. Tons of people in the top echelons, including the CEO, were recently fired, and this is one of the biggest banks in Europe. So we're paying close attention to that in terms of risks around the credit market. China celebrating. Now again, everything is so manipulated in China, but I do suspect before trade war escalates, we get two heads up typically. Number one, we're seeing the Chinese stocks sell off hard ahead of the U.S. equities selling off sometimes. And then two, we're seeing their currency devalue, usually right around that time. So this could be the best heads up we have in terms of predicting the next escalation in the trade war before it happens. So clearly everybody's happy right now. The currency exchange rate has sold off, so Chinese are supporting their currency, protecting the value of their currency, which tends to indicate that we're going to have a period of easing coming up, hopefully till, well, we'll see. The big picture, though, continues to be that China is devaluing their currency to offset the treasuries. This is causing a ripple effect, making all the other countries around it forced to devalue their currency. This weakens their currency against the dollar. All their debt is denominated in dollars. So what do? They print money to pay the interest on their dollar-denominated debt. This continues to put the overall pressure into pushing money to American products. Euro continuing to weaken against the dollar. Same picture, same story. So this all indicates to me that the Fed will have to lower rates to make the dollar not too strong and cause a lot of problems in the currency markets. Like to keep an eye on oil. Don't want it to be too expensive. That would put pressure on the Fed to raise rates because it would cause inflation. On the other side, if it gets too cheap, we have all sorts of demand and growth things to be concerned about. So right around the 60 level is pretty healthy from my point of view in terms of trying to predict the stock and bond market. Gold, I think the run-up is not over yet. Just a chart at that. I do suspect some profit taking and a period of weakness in this product currently. Seeing that German bond have a little bit of a bounce correlated with the TLT. So this is my best guess at what will happen with U.S. Treasuries is to look at the bond on the German. And so this has really been a great indicator for predicting everything. You can see it's just been plummeting lower, and I think during the next escalation, it will plummet even lower. Okay, some tweets I've collected. Trump tweets, the economy is doing great with tremendous upside potential. If the Fed would do what they should, we would rocket upward. So a lot of people think the Fed's this independent thing ran by Congress, but really they are controlled by these banks, and the banks certainly have their people all the way through the government. So whether they're putting on a show with the Democrats and the Republicans, I think at the end of the day it's more of the rich against the poor. So we'll see. We'll see if the Fed did not drop rates come September 18th, I would expect that there is more political drama going on behind the scenes and that they actually want to create a recession and get Trump out. Now remember, the banks love China. They love globalization. And they have a strategy to really pull money out of the entire world by having the monopoly on the money supply and being able to charge interest all around the world. So if they were to pressure the Fed into doing something like not dropping the rates, I would be very concerned that they want to cause a stock crash and try to get Trump out of office because, again, they're losing a tremendous amount of money that's been created between the Chinese and American economies. Not necessarily good for the populace, but great for the banks. So that might be a surprise for all of us if the Fed does not drop rates come September 18th. Now, I think they will, 25 basis points. If they do 50, I'll be a little surprised. We'll probably have stocks fly up really quickly. But I'm kind of thinking it'll just be 25 at this point, especially with the bond yields selling off today. So we'll see. GDP still remaining strong and creating a lot of debt in the U.S. We're being able to fund the debt easily. So if we create a ton of debt, push it through the economy, that should keep the GDP high. And again, this all points to a strong stock market until we get trade war escalations. Job market's still strong. China's Ministry of Commerce, China and U.S. trade teams have been in contact. China urges U.S. to remove sanctions on Huawei. I really have two big things I'm paying attention to. Number one, are we going to give China more time with Huawei? Because if we were to cut off some of its processing chips and its operating system from Google, that would be a huge detrimental blow to one of China's biggest state-run companies, Huawei. So if that happens, I do think the Chinese would get very upset and extremely retaliatory, and then we would have to look out below on the stocks and aggressively adjust our options to benefit from bonds and gold going up. Now, on the other hand, if they continue to extend it, which is what I'm expecting, and just raise these tariffs, and the Chinese just devalue their currency a little bit, I think that's the perfect recipe for stocks to float up, for bonds to hang out where they are, and maybe for gold to slowly rise as well based on the Fed lowering rates. Now, on the other hand, if we get aggravated and put Huawei out of business by putting all these sanctions on it, I would suspect all hell is about to break loose. And so on the other hand, I think if the Chinese would buy a tremendous amount of farm goods, that we wouldn't end the trade war, but I think that Trump would potentially delay tariffs and or allow Huawei to continue doing business as normal. So if that happened, I'd expect stocks to fly up, especially emerging market stocks or ETF, and I'd be concerned about the bond market trade in our portfolio. The current setup we have on the bonds does very well using the option contracts to profit from the TLT going flat or down by selling an in-the-money call and buying an in-the-money put. So easy for us to adjust that. This weekend, Chinese are trying to show strength. They really don't want the people in China to think that you can revolt and protest against their communist rules and laws, and that's exactly what's happening in Hong Kong. It's getting out of control. That's really the joker, the wild card that I think is going to be hard to predict when things are going to get out of control in Hong Kong. Will there be bloodshed? So that's something to keep an eye out on and is continuing to develop. Another good reason to have that long gold position. The Epstein case seems to be there's two major things going on in terms of scandals I'm following. One is the Epstein case, which is obviously a massive cover-up. You know, is he even dead? Is he in witness protection? Is he just being... The big conspiracy is that he was essentially... his job was to create blackmail on powerful people, and in doing so would take over managing huge sums of capital. Apparently he only had one client, which was the Victoria's Secret guy, who's apparently working for some people in the Middle East. So this is all developing, but the cameras went down, all the guards were magically sleeping, the autopsy report doesn't come out. The doctor who did the autopsy is a shady guy. and no one's cooperating. So I think there's more to this story. And then the same breath, we have the Overstock CEO who resigned from Overstock. And if you go to his website, you can read all of this. Deepcapture.com is his website where he's blogging about it. And essentially, the FBI told him to have a relationship with this Maria Butina person. He was telling him that she's trying to spy on the Trump campaign. They allowed it to happen, and then later on put her in jail for a bunch of time. And apparently, you have to read it, but it seems like there's quite a bit of drama. Now, he's claiming that she was also spying and creating blackmail against Hillary Clinton as well. So, very curious if these two things are related and what the real story behind it is. And apparently, according to Patrick Byrne, the CEO of Overstock, that this is all going to be exposed in the upcoming months, and it's going to be the biggest political scandal in history of the U.S. So we'll see how that plays out. Some news from Bloomberg. Huawei's a big question. If they get shut off of Google's Android operating system, that could be a pretty nasty bite for them and for Google. So we'll see if that gets extended or not. And if the Chinese start to buy farm goods, that could totally take everybody off the suspected path we're currently on. Hong Kong police banned a protest planned for Saturday, so this could be exploding in their face this weekend. We'll see. We've got U.S. warships sailing near their South China Sea, where, of course, they agreed not to build up a bunch of military, and they have over the last 8 years on Obama's watch. And so that's really our big... I'm also carefully watching to see what's going on with the political viewpoint from... we're used to having CNN and Washington Post slamming Trump, of course. That's to be expected. But is the Fox business station now is starting to get some upset tweets from Trump. So if we do have a change of presidency going into the next election, that's going to be critical for how we position our portfolio. So we're just trying to get a feel for what's going on with that. So yeah, the cameras were turned off. It's just complete cover up on this case. And now they're talking about a 100-year Treasury product, which is funny. I mean, if you can get people to lend you money for less than the expected inflation for 100 years, of course, government's going to try to soak that up. So it'll be interesting if that really happens. And if so, what impact it has on our TLT, because this would become part of that TLT product, which is 20-plus year. Now, the longer the bond, the more sensitive it is to yield changes in terms of the value of that bond. So that could make the TLT even more somewhat volatile based on yield changes. 18.5 million Treasury futures traded today, the third highest of all time. So we did expect a sell-off in the TLT today with our trade alert, and that has been unfolding. And that's, again, because I think we have a period of peace ahead. Nothing's making progress on the trade talks. We're at this point where it's a bunch of unknowns, a lot of risk, a lot of uncertainty, and that's all just boiling over all the pressure into U.S. products until we see what happens. Here's another little quote from General Robert Spalding, who's retired. Google, Facebook, and their Chinese partner have sunk hundreds of millions into a subsea internet cable that the U.S. officials are seeking to block on national security grounds. So it's all starting to build up the pressure. Here are the people Trump is tweeting about, and they're taking notes of it. Just funny to see how many times right now the Democrats dominate his tweets, but after that it's the media, then China, then Mueller, Congress, Mexico, Iran, Hillary Clinton, New York Times. So it's kind of just a funny tweet there. But he does have the most influential Twitter account for the stock and bond market, so it's critical to follow trends going on there. Here's the 10-year government bond yields around the world. Negative all over the place, absolute insanity. And then you got the US at 1.49. Here's another upset tweet about the Federal Reserve from Trump. And we got our live webinar in a few minutes. The last thing I'll leave you with is a great interview from Buffett. I really liked it. The key highlights is that he's still constructive on the U.S. equities market with the rates being so low, but he's concerned that things will escalate between U.S. and China. Now he's actually saying he'd be interested in investing in China, which is curious because other interviews he said he's looked and couldn't find anything. So that's about a 1.5 hour interview with Yahoo Finance. Good final wrap up. And so again, if you are missing out on trades, call Dean. Get your upgrade in so you don't miss out on future trade alerts. We got a live webinar in a few minutes, so I'm going to go ahead and wrap this up and see you guys on the next trade.